Hello everyone, we are from Group 4. Our group is going to present about the determinants of stock price, a study on Malaysian financial market. Our member including Lau Soo Hui, Mathew, Jong, Wong Shet Nee and me, Lim Zhi Yi. Now I am going to present the descriptive analysis. The dependent variable of this study is stock price, while earning per share, dividend per share, gross domestic products, interest rate, oil price, as well as inflation are the independent variables of this study. These results show that GDP has the highest mean among all of the variables, which is 238.6995. Meanwhile, interest rate has a mean of 2.5211, which is the lowest in comparison with the others variable. In terms of others 5 variables, the mean of stock price, earning per share, dividend per share, oil price, and inflation are 4.4595, 46.9216, 24.1884, 227.8521, and 100.9. respectively. Moving forward to median, GDP has the largest median with the value of 255.02, followed by oil price and inflation, which has the median of 235.8 and 100 respectively. Interest rate has the smallest median of 2.83. In the meantime, the respective median of stock price, earning per share, dividend per share are 4.24, 47.68 and 25.4. For standard deviation, stock price has the lowest standard deviation, which is the value of 1.7344. On the other hand, GDP has a standard deviation of 94.0377, which is the highest among all variables. The standard deviation of interest rate, dividend per share, inflation, earning per share, and oil price has the value of 3.7263, 7.0792, 13.3913, 20.2217, and 77.7579 respectively. Next is correlation metric. The results show earning per share, dividend per share, GDP, and oil price are positively correlated with stock price, while interest rate and inflation are negatively correlated with stock price. This result implies that when earning per share, dividend per share, GDP, and oil price increase, stock price increase as well. But when interest rate and inflation increase, stock price decrease. Based on the results shown, interest rate is the only variable that's having negative relationship with all of the others independent variables. That's all from me, and I will pass the presentation to next presenter, Mathew Jong, to explain the diagnostic test of this study.
Unit root test has been conducted to check if unit root ADF test is selected for the diagnostic checking. The test has been carried out using both level and first different data, and the result has been demonstrated in the form of intercept. Based on the rejection rules of the p-value approach, the null hypothesis will be rejected if the probability value is below or equal to 0.05. Result in table 4.3.1.1, all the variables are non-stationary and level accepted interest rate INT, which is stationary in both form of intercept as well as trend and intercept. First difference per share DPS is the only variable that was detected with unit root, both intercept as well as trend and intercept, while the other variable are mostly stationary. Since there is no unit root detected in the most variable at the first difference, therefore first difference data is applied in the research for regression analysis. So the DPS is non-stationary at the both level and the first difference, hence the variable is dropped. Test has been applied in this study to check the variance inflation factor VIF approach showing in the table 4.3.2.1 above illustrate the result obtained, which include VIF value of each independent variable as well as the average of the VIF value. So according to the rules of thumb for interpreting the VIF of 1 indicate that the variables are not correlated, while a VIF between 1 and 5 implies the variables are readily correlate. So if greater than 5 is highly correlated. As we can see, EPS, DPS, GDP, INT, or IL, INF, the VIF value is 1.6093, 1.9331, 7.5004, 1.5258, 6.7767, and 2.1591 respectively. So conclude the VIF is below 10, so no severe multicollinearity is detected, so no remedy is needed to be addressed. Autocorrelation test has been carried out, shown that the F statistic generated from the test as well as its probability value. The null hypothesis of the autocorrelation test indicate there is no serial correlation exists in the estimation model. According to the rejection of p-value approach, that the null hypothesis will be only rejected in the probability value in less than 0.05 or equal, based on the result as depicted in table 4.3.3.1. The probability value 0.6255 is far higher than 0.05, so the null hypothesis is accepted. And in short, there is no autocorrelation detected in the model and no remedies is needed.
Hi everyone, I am Wong Shet Nee and my metric number is 71972. I will present the fourth diagnostic test, which is heteroscedasticity test. This test is to check if the variance of the error terms is heteroscedastic or homoscedastic. From the table above, it shows the profitability value of 0.4269. Hence, null hypothesis is accepted in this study, which the number has exceeded 0.05. Therefore, no heteroscedasticity problem is detected. The next diagnostic test is normality test. This test is to determine the normality of error term. The profitability value shown as 0.8986 and the value is greater than 0.05. Hence, the error terms are normally distributed as the null hypothesis is accepted. After all the diagnostic tests, I will present the result of OLS regression. The estimated regression equation is developed besides the diagram. From the equation, the intercept value in the regression is 0.1738. This indicates if the value of all the variables are 0, stock price will still maintain at a value of approximately 0.1738. And for the relationship between dependent variable and independent variables, earnings per share and gross domestic products are positively associated with stock price, whereas interest rate, oil price, and inflation rate have negative relationship with stock price. That's all from me. I will pass the presentation to my group member. Thank you.
Hi, I'm Soo Hui, and now I will proceed with the conclusion of this study. The main objective of this study is to identify the determinants of stock price in the Malaysian stock market, specifically the financial sector. The empirical findings that obtained in this study found that all explanatory variables have insignificant impact on the movement of stock price in the Malaysian financial market. The findings draw an implication in which there are other factors that were not included in this study that determine stock price in the Malaysian financial sector. Next, let us proceed with the discussion of the findings. For earnings per share, Gregory et al. Stated that investors prefer to rely on a firm's book value in forecasting the potential growth of a firm instead of the firm's earnings. Hence, the results imply that investors in the Malaysian stock market have less emphasis on firms' earnings. In terms of gross domestic product, Secretary and Kumar stated that even if there is an increase in a country's gross domestic product, it does not imply that the prosperity is evenly spread to the citizens. Meanwhile, Ang et al. Highlighted that a well-performing economy does not certainly guarantee high return for investors in financial market. Therefore, the variation of GDP would not bring influence to the investment model in capital market. Proceed with interest rate. Gupta et al. Concluded in their study that the historical information of interest rate does not provide significant predictive content for stock price, and the results imply that investors do not rely on interest rate to predict stock price. Next, in the context of crude oil price, Hansi and Pogosian found in their study that crude oil price has insignificant direct effect on bank profitability. These results indicates that crude oil price is not the dominant factor that affects the profitability of firms in financial sector, since firms in the financial sector do not directly engage in oil-related business. For inflation, in a study of Tuso et al., inflation was found having insignificant relationship with stock return in 6 industries out of the 9 different industries examined. The researchers interpreted this finding through emphasizing the different conditions that linger around the different sectors, which may cause the stock return to react differently across different industries. In terms of the recommendations for future study, there are 2 suggestions for future researchers. First, future researchers should include more different industries in their studies instead of restricting their study to only one sector. Next, future researchers are also recommended to consider more different variables in their study, and the factors are not necessarily restricted to only company fundamentals as well as macroeconomic variables. That's all from us. Thank you.